My name is John Carroll. I'm the editor of Endpoints News, which is a daily biotech news source and report that comes out about the US and Europe and Asian biotech markets and how they've been developing. Our topic today is about IPOs. And obviously we've had a huge amount of interest and discussion as it relates to everything that's happened with the biotech IPO market over the last few years, particularly after the tsunami of IPOs swept through the industry over 2013, 2014, 2015, and then not so much. But, and that's what we're here to talk about today. I'm joined by, on my left here, by Chris Barden, who is the Managing Director of MPM Capital Oncology Impact Fund, David Sabo, the Head of Life Sciences and Healthcare Banking at Silicon Valley Bank, and Simos Simeonidis, who is the Chief Biotech Analyst at RBC Capital and someone I follow on a regular basis. I can't get through a day without reading one of his notes, and they're always interesting. So I want to start off here. Everybody take about a minute just to talk about what it is that you do and why we're here today.
Great, nice to meet everyone. So my name is Chris Barden. I'm actually a public market investor. I started my career in investing about 10 years ago, but most recently was at Fidelity and their pension fund and government group called Pyramus. After that, I was working at a fund called Burrage Capital, which is a diversified public investment fund. And recently, over the last year, I've teamed up with MPM Capital to actually launch an oncology dedicated fund. So we just closed that this April. It's the Oncology Impact Fund, and it's dedicated to private and public oncology companies. Nice to meet everyone. Did mine not work?
Okay.
Is this better?
Yeah, it's better.
Okay, all right. We'll try this again. So, John, thank you for having me here today. As John mentioned, my name's Dave Sabo. I run the healthcare and life sciences practice at Silicon Valley Bank. Silicon Valley Bank, for those of you who have not come across us before, is the largest bank in the world dedicated to the innovation economy, which we describe as technology and life sciences. Our claim to fame is banking a lot of the venture-backed early-stage companies in the market, which gives us a lot of insight in terms of the next big thing, future IPOs, which hopefully Chris and her team will invest in, and really the next wave of disruption coming through the ecosystem. More recently, we've had the good fortune to watch a lot of our clients grow up and become public companies and go on to have things like revenue and even, God forbid, cash flow across the biopharma industry. So we work all the way with two people and a molecule and a big idea, all the way up to the metavations of the world. So pleased to be here.
Thanks. Thanks, John, for inviting me. And I have to also say, for full disclosure, that when I get up at around 6 or 6:30 in the morning, John's handle on Twitter is one of the first things I check to see what happened the night before for fair and balanced reporting in biotech. So thank you very much for joining us. My name is Simos Simeonidis. I'm a biotech analyst. For the past 10 years, I've worked at Morgan Stanley, Cowen, and now at RBC, covering the biotech sector. I'm a former molecular biologist, worked at Novartis and GSK doing business development before moving to Wall Street. And that's it. We'll pass it back to John.
Okay, so Friday night, I don't work a 9-to-5 schedule. Friday night, CRISPR Therapeutics puts out its S1. It's doing a $90 million IPO, probably more than that when they get to it. And it's one of those IPOs I've been waiting for about 3 or 4 months now. I've been waiting for them to actually file it so I could look at it, which is always very interesting. And to me, it says a lot about where the IPO market is right now, which is companies like a gene editing company that's in very hot kind of a space is still rolling out, still doing IPOs. Just a couple of little quick facts in terms of where we are right now with the IPO market. There were 9 VC-backed IPOs in the second quarter of this year that earned $533 million. That compares to 14 for Q2 of 2015 that brought in $1.24 billion. Now, obviously, 2015 was one of those years where things are just fantastic and nothing can seemingly go wrong. And that's not the case anymore. Things have changed a lot. So let's just jump into this thing right now. CRISPR Therapeutics does an IPO, a lot of companies wouldn't. So Chris, I mean, what's working right now in terms of what do you have to do right now to have a good IPO?
So the way I kind of see this last biotech, bull period is really due to two factors. One is really due to outstanding performance of the major big cap companies. So we really saw all of those companies finally launch and make money on big drugs, billion-dollar drugs, blockbusters. And I think that basically kind of led to a spillover effect all the way down to mid and small cap biotech. So one, we're seeing real revenues and heaven forbid earnings and cash flow in our industry. That's what's driving generalists into the market. Two, we're seeing a really low interest rate economy where there's a tremendous amount of free and easy capital, a lot of M&A going on, which is also stirring generalist interest. So I think those are really the two big factors before kind of going into this year. Where are we now from those perspectives? Well, one, I would say from the perspective of the big cap companies, and CMOs will probably have a lot to say here, things have slowed down a little bit. Expectations got a little heated. Growth rate, phenomenal, has slowed down a little bit for almost all of those products. And so from that side, the interest has become a little dampened, especially relative to enthusiasm. And two, especially as we see kind of the interest rate environment going up, if M&A starts to slow down, I think that's when things potentially would get a little sore. That being said, where are we today? I think the market looks actually, I would say it's kind of a have and have not market, and that's something we discussed when we were preparing for this event. The good companies are still getting out. Those companies that have value-creating events, those companies that are closer to the clinic. I think some of the earlier stage companies may have more difficulty these days. They're certainly not going to be getting the valuations they saw. They're not going to be getting the step-ups that they saw from their private crossover rounds that happened 6 months before. But quite frankly, that may or may not have ever been appropriate. We were in a period of incredible enthusiasm and probably exuberant enthusiasm. So, I still think in this environment we're seeing high quality companies come through, but it's going to be a little harder, and we're not going to see the step-ups that they were seeing in the years past.
Well, there's kind of a Goldilocks effect going on here. If it's just the right temperature, if it's just the right phase, if things are going its way, the Goldilocks companies tend to do pretty well, and then everybody else gets kind of frozen out or doesn't do very well. Simos, tell me a little bit about what you're seeing that's working.
I agree with what Chris said. I think there's different categories, a couple buckets at least of companies that you see do well. So, you could have a company like CRISPR, that I think, can do well, like Editas did pretty well, at least for a while, because it's a very differentiated or viewed as differentiated technology that people really want to buy into. And then you can have a company like that has data or a differentiated actual product that I think people will back regardless. So I think those things that we've always seen people put money behind, I think that those are going to continue to work. I think it's going to be a lot more selective than the past few years because the exuberance that we saw in 13 and 14 is just not there anymore because people have gotten burned from the air coming out. So I think if you have a real product, because what we saw in the past 12 months is even when things are bad, when you have a good clinical trial result, the markets reward you. The stock is up 100%. Even I think it was in March of this year when the markets were really bad in biotech, we had the AML data from the small New Jersey company that ended up being acquired by Jazz. I can't remember its name, but it was AML, a disease where nothing works, and they had a fantastic result. The stock was up 100%. So you see the markets working. So if you have a product, even in the dead of winter, people are going to buy those stocks.
Well, David, we talk about people who buy, but I mean, a lot of people would say that the generalist investor just isn't there anymore.
Yep, I would agree with that, and I think Chris hit on this a bit in terms of just the exuberance of capital, and certainly I think many of us in this room benefited from that. And when biotech became such a huge part of the NASDAQ composite, you no longer could ignore it, and people who didn't necessarily have that specialist long-term view really had to get up to speed in this industry and start investing in it. That has dialed back quite a lot, and especially when we look at the crossover activity, the reversion to the crossovers that are still active are those, for the most part, that really do have a dedicated specialist, if not complete fund, at least people within those funds that are really focused on it. That contraction in crossover activity, I think, actually continues to be a good thing for the market, because the long-term health of an IPO market is predicated on aftermarket performance. And so far, year to date, the aftermarket performance as a class has actually been pretty good. If you look at the class of 2015 from an aftermarket standpoint, it's kind of the inverse. So roughly 70% of the IPOs so far have traded above offer as of yesterday. Who knows what it is today? The class of 2015, it's actually only 30% are trading above offer. And so is there something to be said around a bit of a tighter funnel for high quality companies to get through, which will drive aftermarket performance and hopefully good clinical data? I think that's good for the long-term ecosystem.
By the way, I always think of aftermarket performance as two different things. There's the hype and the enthusiasm, and sometimes you get that for free. And that's what we were seeing in the public markets over the last 2 years. Nothing would happen, the company would double. Of course, everyone wants a piece of that, so all the generalists are flooding in. But then there's aftermarket performance that actually comes from real progress, generating milestones, hitting clinical data, regulatory approval, all the things that actually generate fundamental value within the industry. So, I would say kind of the fluff is a little bit out from the first part that I just described, but we're going to have to make money the old-fashioned way, which is to build drugs.
Well, that's an interesting point, because the gene editing companies that we have seen go public so far, Intellia as well as Editas, they're years away from seeing something definitive in terms of real data. I mean, we're not even going to see this new company, CRISPR Therapeutics, get into the clinic until the end of next year, and that's their first program. So how do you keep investors interested over such a prolonged period of time? I mean, both Intellia as well as Editas are trading well below what they started out at. I think the high for Intellia that I just checked was $29 a share. It's now trading around $19 a share. So if you're a company like that, I mean, do you not go IPO? I mean, do you not work out something like that? Do you stay away? How can you do that?
I mean, look, as a company, you should take money when you can get it.
Right,
so
exactly.
If you can't get there, I
And
would recommend it. And sure, that's your job as a CEO, is to raise money. But what I would say is when people get enthusiastic, the high quality assets that are later in clinic or generating revenue, those are obviously fewer and far between. And so you can start to go earlier, and you start to get interested in phase 1, phase 2. You start to go earlier into platforms, and at some point you're back in Intellia and Editas, which are incredible platforms, but as you mentioned, will not hit reality for quite a long time. So I think what happens is in a contraction is that all the very early companies, well, we start to kind of be a little pickier. So things that are very earlier without tremendously compelling platforms will fall by the wayside. And now as public investors, I want to wait for phase 1, phase 2, preferably even later stage data, spec pharma, all of these kind of old-fashioned real milestones, I would say, come back into vogue.
So I think you're touching on an interesting irony, though, which is you'd assume that in a more discerning buy-side environment that there'd be this flight towards later stage assets, which, at least from, maybe a naive perspective would be less risky assets. And the reality is that the IPO activity we've seen is not at all late stage activity. It's to your point, the gene editing, which is really selling a giant idea that is years away from clinical progress. And to some degree, as an investor, I wonder if there isn't a benefit to selling the dream and having a little bit of buzz around that without that risk of, hey, we're flipping a card and hoping for good data. That can be good data, it can be bad data, it can create value, it can contract a lot of value. Just one other point on this is there was an interesting report that I'm sure many of the people in this room saw around the probability of success that Bio put out at different clinical inflection points. So probability of going from phase 1 to approval, and they pegged that at 10%. And probability of going from phase 1 to phase 2, it leaps to, I think it was 63%, and even higher if there's a biomarker tied to it. As an investor looking at value creation, it's absolutely tied towards, phase one assets. And what we've seen so far year to date, it's preclinical and phase one assets that have gone public, not entirely, but that is the majority of the IPO activity. So I think there is something around that. You have a higher probability of actually creating value going from phase one to phase two than in the other parts of the development cycle. But interested in the Wall Street perspective to that.
Yeah, I would say to the question, what do you do? From the company perspective, I think it's what Chris said. You take the money if it's available, especially at a good environment, because for these early stage companies, it's very uncertain what will happen in your preclinical experiments and when the money is going to be available. When you're addressing investors, there's a couple of different audiences, and the answer depends on your investing horizon. If it's a long-term investor, if it's a crossover and a more long-only oriented, you're making the bet that this is going to be a potentially transformative technology like a CRISPR, and you don't really care if it goes up 10 or 20, 30%, because you think this is going to be a 4 or 5x. It will be like an Alnylam type of situation. If you're a hedge fund that's buying it and you might be thinking you might flip it in the next 90 days, you're trying to time the market. So it's, it really depends. So, but I think from the company perspective, if you have the ability to go out and raise significant amount of capital, given how much you'll need over the life of going from where you're at now to phase two, you go ahead and do it. From the Wall Street perspective, of course, there is the bias of, the banks wanting to facilitate that, to help them raise that money because, for the obvious reasons.
By the way, the fact that these early stage
Keep going. Yeah.
By the way, the fact that these early stage companies are going public suggests that the market is actually still pretty decent.
Right.
I mean, if you think about back in '08, or kind of 10, 11, Horizon Pharmaceuticals came to my office and sold me stock for $2 with 100% warrant coverage. So that was that environment. And look at today, you have companies still going out 2 years from the clinic at $800 million plus valuation. So things are bad now, but they're not nearly as bad as they've been. And I'm sure most of you will remember that.
Well, one of the key things that it seems that you really got to have right now if you want to do a good IPO is your syndicate's got to come back in and they got to buy a good 30 or 40% of what you're going to put out there. I mean, tell me a little bit about that. I mean, because you've got to get the crossovers involved in this thing. You've got to be able to put this out there with a lot of strong backing because the generals is really not out there in the market so more. So what are the key elements? I mean, if you were putting it all together, how does this all fit together in terms of the venture capital that goes into the company and trying to set up your company for an IPO?
I mean, if you could have your everything planned ahead of time, if you could have your choice on what to do, having a certain amount of the IPO spoken for by MPM or...
Well, how much?
Yeah.
I mean, what do you think is the magic figure here?
I mean, some of the IPOs that I see that we're talking to right now, they have at least half of it spoken for. So if it's an 80 million IPO, they have 40, and then I know that IPO is going to happen. If it's a halfway decent company, which by definition it is, if they have, kind of blue chip VCs, supporting them, I'm thinking if it's something I've vetted and the bank is underwriting, I know this is something that's going to happen because. From the 10 companies I'm talking to, even if 2 of them happen, this is going to be one that I'm going to cover because this has a very high probability of happening versus other ones that I'm looking at that there's no VC backing, and if the world falls apart, this is not going to happen. So I'm not even spending much time talking to KOLs or learning that new therapeutic area because I've seen it fall apart before versus a company like, for example, a year ago or a year and a half ago, we did BioTie, which was a listing in the U.S. and more than half of it was spoken for by OrbiMed and a couple other VCs and crossover funds, and they had a phase 3 asset. And when we would speak to funds, they were very enthusiastic, and when I talked to KOLs, they knew they knew the drug, they were very enthusiastic, so everything was checking. So if you have 30 to 50% of the IPO already spoken for, number one, and it also helps to have a big name fund because then they attract. I mean, that's how the game is played, so to speak. They say, Chris likes this IPO, and then people call Chris and say, what do you think? And so it kind of serves as an anchor and a validation for the offering.
Yeah, I agree with that. I think that we're in a market where there's got to be a lot of insider support. I think the more interesting question is almost what happens if you can't go public and you have that crossover in your cap table, which I know there are a lot of people and a lot of board meetings happening with that very discussion taking place. And I heard a stat, one of our internal analytics colleagues identified that over 50% of the crossover investments that took place since 2013 have yet to go public. And so there is a lot of capital sitting there that was expecting to be liquid that is now illiquid. In conjunction with that, we're seeing the formation of some very large secondary funds from various opportunistic investors. Some VCs actually have pivoted into a secondary strategy with the idea that they'll be able to provide liquidity to these crossovers who really aren't playing the long game, who are hoping that with a self-fulfilling prophecy of strong internal demand, getting a successful offering, oversubscribing it, and flipping it into the public markets, that works until it doesn't. So it'll be interesting to see how that plays out. I guess the other thing that is important for companies to think about is not just the IPO, but if you have 50+% of your shares being acquired by insider investors, what is your secondary strategy? And what is your timing of your follow-on? And if you have a 20% or less public float, that changes your ability to raise capital in the public markets. And I feel like there's so much focus on just getting public that you have some of the severely wounded public companies trying to figure out how do they actually do a secondary to get to that clinical inflection point. And there's not a lot of discussion taking place around that right now.
That's a great point because you don't actually. That's a great.
Hello. My behind.
Hi. Hello.
I think we're okay.
Hello? I was saying that's a great point that you mentioned because a lot of companies go public, but you don't want to go public and be kind of the living dead kind of thing. And that happened a lot in 2008 and 2009 when companies were public but had no liquidity, no float, and therefore no interest. At Fidelity, we weren't even allowed to cover a company unless there were 2 million shares a day of liquidity because how else could the $80 billion select fund get involved? And of course, they're not interested in buying 0.0001 basis point of their fund into a name. So really, I think that's a great point. If you want to get public, you need to get strong, you need liquidity, you need float, you need the ability for generalist investors to get there into your name. And that's definitely something you need to plan. Remember, IPO is not a magical, mystical being. It is really just a financing event. And if there are alternative financing events that are more attractive, that's great. But you have to think about it as a long-term financing plan and a long-term plan to bring in new and bigger investors.
Well, speaking of other alternative financing events, obviously when IPOs are a little bit chilled, there's a lot more attention on M&A. I mean, recently we saw the $14 billion Medivation deal go through. That would indicate that, in terms of valuations on biotech side, still really high. I mean, you got to give David Hung credit. I mean, he really tapped that for everything it was worth and then some. On the other hand, you recently saw the recent buyout of Raptor a couple days ago for $800 million, not a big premium over what it had been trading for. So what do you think, thoughts in terms of that whole thing? I mean, where do we go on M&A side if the IPOs are a little bit wavering like that? I mean, does this put more attention on the M&A side? Chris?
I mean, I see M&As continue to go strong because basically, anytime you talk to pharma, and this is obviously a recurrent theme in our industry, they are looking for revenue, they are looking for growth.
Right.
And Medivation was really a perfect profile for that. How many mid-cap companies are there out there that can post that type of revenue growth opportunity that's going to make a difference for big cap pharma? I think interest rates have been very low, which means the cost of capital is nothing. So you basically look at companies across many industries, and you see tremendous amounts of M&A activity. So now, of course, the market melted down 2 days ago because we heard that the Fed might be raising interest rates, but we have a long way to go before I think that makes a dent into the capital decision-making skills of large cap pharma. So I think M&A activity is ongoing as long as we as an industry continue to generate data, new drugs, and potential regulatory approvals. Simos, maybe you have a comment on that.
Just quickly, one thought I had was, originally our thought was, okay, if the IPO market, if the spigot turns off, then companies that otherwise would have done an IPO to get to that inflection point with hopes of having an M&A event on the other side of that, maybe they wouldn't have the capital to do that, so they'd be forced into an M&A scenario. We're not really seeing that play out this year, and I think part of that is because off of these incredible paper returns in many cases of the last couple of years, we saw a decent amount of fundraising towards the end of 2015. And so you have, I think, a smaller number of dedicated life sciences venture capital funds out there, but they're all pretty well funded right now, and they've got new capital that they're deploying. So we're actually seeing an increase in the median financing sizes in the biopharma space, which I think is actually going to allow these companies to continue to build value. And M&A will not, I don't think, be done in a distressed scenario, but really based on positive clinical outcomes or really disruptive technology. One of the things we look at is potential distributions to the VCs, and we use a very high-level analysis on that, which assigns a certain ownership of the pre-money value of an IPO and a certain discount of milestone payments in an M&A scenario. And we think, 2015 was a record that I don't think we'll touch, but we still think we're going to be at like a five-year high this year, just based on what we've seen in the first half of the year.
Simos, valuations? Premiums?
Yeah, I think the M&A is going to continue to do pretty well. I don't think the IPO market has slowed down considerably to have a major impact on M&A. Again, I think even though there is a relationship between the two, when there's a major difference on how IPOs are doing, pharma has its own timetable and way of doing things, and it takes a long time for M&A to happen. I mean, there can be opportunistic, but things in pharma move, much slower, and they tend to be, for all the blame that Wall Street analysts, place on pharma, they can be pretty disciplined. And you saw the first bid, for example, you mentioned Medivation, the first bid from Sanofi come in at $51. And David Hung said to them, you're just being opportunistic. He called them out just because we're at a 52-week low of $26, and the company ended up being bought for $80, which is a lot of money, but the market ended up being efficient, so to speak. So I think M&A is going to continue to happen at its own schedule, and regardless of this small dip, it will play a pretty significant role, and it's going to be based on having a good drug, and like Medivations, having a differentiated agent and having something there was a need for, whether the valuation is high or not. You saw Abbott a couple of years ago buy Pharmacyclics for $21 billion, then the Stemcentrx for 5 or 10 billion. Again, I guess it's the same company, so maybe that's an outlier, but I think the M&A is going to continue to be pretty healthy.
Yeah, that's what I was going to mention, is that I think Medivation's on a very far end of the spectrum in terms of that's a real business with high growth and a disruptive drug in a huge market. The Stemcentrx and the Acertas of the world, I think, have an incredible dynamic around fundraising and an interest in biotech. And I can bet you anything that Peter Thiel has a strong interest in biotech after what happened with Stemcentrx. And I just think the more you see those happening, you're just not seeing those in other parts of the innovation economy. That is just incredible value creation.
Well, tech IPOs in general have been pretty woeful over the last 6 months or so, right? So one of the things, Stemcentrx just took me out of left field. I didn't know where that company came from. The first thing I hear, it's got a $5 billion valuation, and then it's getting bought out for $5.8 billion in cash, and then another 4.2, I think, in billions in milestones. I mean, that's just a phenomenal amount of money. It does underscore, I think, a lot of things, certainly as it relates to the companies that are buying them, and that they really do need innovation. I mean, if there's only one thing that I've seen over the last decade that I've been covering the biotech industry, is that the big players here aren't very good when it comes to actual innovation. I mean, they really do need to buy things in phase 2, phase 3, where they can get a hold of something and then rely on their development expertise and the amount of cash that they have to turn those into products, and then to turn products into marketable types of products, drugs that can get out there and actually make money. Those are the things that they seem to be really good at. Some of them are working on the innovation side on R&D and trying to do some different things like J&J, but I mean, one of the things that I just was looking at this morning was that last year the FDA approved 44 novel drugs, and so far this year at the end of the third quarter we're at 16. Now we've been on a kind of an upward track here where we've been seeing some increasing numbers on approvals, but 2016 is going to see a dip at the very least, and perhaps a significant decline. Now, I would think that that would put pressure on these companies to buy these companies and buy these products so that they can get closer in on that. So where do you see, I'm kind of curious, everybody seems to be positioned as somebody that has to do a deal. I mean, you see Biogen, you see a lot of these different companies, Gilead, you see the big pharma companies like GlaxoSmithKline, and these other companies as well. I'm kind of curious, who do you see as kind of like stepping out? AbbVie, buying a lot of different things. Are there any companies that really kind of stick out as, you know, these are the companies you're going to find at the table? Sanofi's got to be looking for something, right? Chris?
Look, I mean, I think all of these major companies. Hello?
Keep going.
Oh, I think all of these major companies are out shopping constantly, and this is part of their regular business growth.
There we go.
Business model. And basically, I would say, I don't know the most recent statistics, but external innovation is as important as internal innovation nowadays. And I would say the other thing, too, is the biotech industry has matured. And really, you know, my fundamental reason for my bullish view on the industry is that we are really on a technological cusp and just taking off. Think about it. In 2000, you know, that was really a bubble, because the truth was there was no business model. All we had was targets. We were years away from a drug. Think about gene or cell therapy. Those things were invented 15 years ago. But now we know how to make those cells proliferate in people. With gene therapy, we know how to actually get these genes into patients reproducibly, into target organs. We are really at a transformative cusp of science and innovation. And I think that is what fundamentally drives M&A, as well as IPOs and a market environment. And really, that is what's changed about our industry. We are mature. There's so much new going on. All these techniques and science hypotheses we had over the last 20 years are now a reality. So I think innovation is ongoing, and basically over time, most of this innovation is happening in biotech, and this leads to eventual acquisition.
It's different this time. I think can we agree on that? Or do you all agree that we think it's different? And what does this mean for 2017? And this is the point, by the way, whenever anybody asks me what's going to happen in the market next year or tomorrow or the next week or anything like that, I say, look, I get up usually and start work at 5 o'clock in the morning. And if I knew the answer to that, I wouldn't have to get up at 5 o'clock in the morning, because I'd be too busy living on my yacht. So I don't know, but I'm sure these experts do. So let's start with you, Simos, next year.
Yeah, if I knew, I'd be back in a Greek island somewhere, not in beautiful Boston. But yeah, I agree with what you said, that there's a big difference between 2000, when I was a grad student or a postdoc pipetting stuff, and now, because we know so much more than we did back then. I mean, I remember I was working on the NF-kappa B, I-kappa B pathway, and 15 years later, Pharmacyclics was bought for $21 billion, a company with a drug inhibiting that pathway. So 15 years later, we had a drug that was one of the most efficacious, safest drugs for CLL, a disease that when Chris was practicing was a lot more severe than it is now.
By the way, you know where the pharmaceutical drug came from? It came from Solera,
Right.
which was obviously a 2000 baby, which
A
never
bubble
lived to
baby.
see the light of day, which is kind of ironic that a target discovered in 2000 by a company who subsequently went out of business is actually now, 15 years later, become one of the biggest drugs, and that's what's driving growth in our industry. It took that long to basically get here.
Yeah. I mean, again, Kadcyla, another, a breast cancer drug that, 15 years ago, breast cancer was, HER2 positive breast cancer was a different disease than it is today. A lot less toxic than what women were dealing with 15 years ago. So the point is that what investors were investing 15 years ago is different than what they're investing now. They're investing in real business models, real drugs. Yeah, I think this year is going to be a dip in NDA, BLA approvals, but I think this probably has to do more with logistics and how the filings happened. I think next year is going to be a pretty decent year. People are more discerning in terms of what goes through, and who knows what the winner is going to be in the CRISPR world, but I think there's real drugs out there, much better than a few years ago, and I'm very optimistic. I think you're not going to see the exuberance of 13, and it's probably good to have, for the health of the market, as David said, it's good to have a kind of a correction. It's not good for the pocketbooks of investment bankers, but that's, again, that's probably good for the market overall.
It's interesting, one of the things, I was talking to Ari Beldergren a few days ago at Kite Therapeutics. He's got obviously a very interesting program going on in CAR-T right now. And one of the things I was talking to him about, just the speed of the ending here, of this last sprint that he's got, where he's going to be taking a drug, taking it to the regulators after just a few months in the clinic and just trying to get a very accelerated review. I think you're exactly right that it does take a long time to do this, because once I started talking about that, he said, now wait a second, I was working in this field in 1985, doing postdoc down at the NIH and things like that, and we were just at the very beginning of looking and doing some lab experiments. So it takes a long time, but it seems like once you get to the finish line, everybody's there really pummeling away, or in the case of Novartis, perhaps not. But I'm kind of curious in terms of the speed of things that are going on right now. Where do you see this?
I think you bring up an interesting point, because if you look at the quote-unquote time to exit, and unfortunately our data includes an IPO as an exit, which it most certainly is not, but that's actually trending down. And it's in biopharma, I think the first half of the year when you looked at IPOs and big exit M&As, it was less than 5 years, and in some cases dramatically less than 5 years. But to Chris's point, some of those technologies started, when I was in grade school, right? So this didn't just show up necessarily. It's science building on, decades of innovation. I think maybe what's different here is the confluence on, better biological understanding around the mechanisms of disease, incredible computational power and genetic insight and cost of sequencing and all of these other innovations that I think are coming in and disrupting, a lot of different areas around drug innovation and company creation. One, just to come back a little bit in terms of how do we think that big pharma and other large players are going to get their hands on innovation, especially if the FDA becomes a little bit of a higher bar. The most active investor in new biopharma private capital investing in the first half of the year was Pfizer, of all people. More than OrbiMed, more than the usual suspects, Pfizer was more active in investing in the first half of the year than any other fund.
They have all that money burning a hole in their
They
pocket.
have more cash than us at PM even.
Do have some dollars, but I mean, that's interesting because, last year we weren't even seeing them in our data, or we were, but they weren't top of mind. So, quick evolution of strategies, the fact that, somewhere around 30+% of Series A's have a corporate venture capital in the cap table. Will those big corporates come in and support some of the IPOs and buy into it? I think they're going to have to. But I think there's a lot of innovation happening in terms of how these larger companies are getting their finger on the pulse of some of these breakthrough therapies.
Great. So at this point, I want to ask the audience if you all have any questions for our panelists here today. And I know we've got a microphone out there somewhere. So anybody would like to ask a question here? Do we see a hand? I see a hand. A little difficult.
Coming. I'm coming.
Oh, we do have a micro. I hope it works. If you can say, James Shirley, Asymmetrics. Who you betting on for stem cell therapies? Stem cell therapies. Does anybody bet on stem cell therapies here? I had thought that the bet on stem cell therapies had ended like 5 years ago or 3 years ago. Any thoughts here on stem cell therapies? Other than the fact that they have a hard time right now. I don't think we have a taker on that question. I would say, everything I've seen on the stem cell side would indicate that it's gotten very cold, and the Japanese seem to be very interested in this thing as well. So I'm very curious in terms of whether something happens with this next, because it's gone into kind of hibernation at this stage from what I've been able to see, because it just doesn't work as well as they thought it would with what they were putting into the clinic. And as a result, there's no investment capital going into stem cells, or very little investment capital going into stem cells. The thing's drying up. People are finding opportunities there. So I'm kind of curious what happens in 3 or 4 or 5 years when it comes to stem cells, because there is an opportunity, that this was something that was extremely hot 10 or 15 years ago and then progressively got colder. So does it come back? There's a distinct possibility of that, but they have a long way to go. Any other questions? I'm going to ask a question just in terms of which technologies you think, if not stem cells, is it going to be CAR T? Cancer's obviously been a very hot field. I think cancer probably gets more investments than anything else as a disease category. Do you see any kind of technologies or market niches that are going to be particularly interesting in 2017? David?
Yeah, I think you hit it. The innovation happening around oncology is amazing. I think there was a public comment from the FDA recently around, hey, let's not have so much Me Too activity taking place. I'm sure many of you saw that. But there is going to be, I think, some really substantial market expanding opportunities around checkpoint inhibitors. And it's hard to know exactly who's going to be the lead there. It's probably multiple companion therapies or combination therapies.
Right.
But it's also going to be, I think there's going to be a lot of carnage as well in that space, just because the number of combination therapies that we have in our portfolio is probably in the several hundred, I would imagine.
I did a panel in London some 6 months ago, and everybody on the panel was directly involved in doing immuno-oncology, doing the checkpoint deals, all the follow-up checkpoint deals, the next generation checkpoints that are coming down the pipe from AstraZeneca and others. And the subject of the conversation was deals, and they were all doing deals right, left, and center. So when does it crash, right? If it's this hot, at some point, it has to get cold, but that wasn't on anybody's horizon. So CMOS, does cancer stay just the hottest thing ever? Through 2017.
I think it's definitely going to, because it's not, not only is it a serious disease, but it's impacted by checkpoint inhibitors, CAR Ts, by all these new technologies that are addressing that same therapeutic area. And with checkpoint inhibitors that have been one of the most efficacious therapies we've seen, we're kind of scratching the surface to being specific on tumor type, combination therapy. So there's still a lot we don't know. We saw the recent failure in first-line lung. So we know that there's a lot we don't know. So we'll find, so one checkpoint inhibitor will work with one partner in one tumor in the first line versus the second line. So there's a lot of work to be done, which is going to take 3 or 4 years, I think. And then the other question is, will CAR Ts work? How will they work? In which tumor types, and in which liquid tumors? So I think those questions will continue for the next few years.
Now, Chris, this is right down your alley.
I'd say obviously I'm tremendously bullish on oncology because we just raised a $500 million fund dedicated to oncology. And
that's got to go for 3 or 4 years, right?
That'll keep us busy for a little while. But I was going to actually add one other thing. So not just the innovation, but the regulatory front, and we touched a little bit on the FDA, is working really well in oncology because primarily, one, there's a tremendous unmet medical need. Two, we understand the exact type of patients we want to treat usually, whether that's, CD19 positive tumors or a specific molecular target. We're able, especially with companion diagnostic, to identify those patients who will best respond. Three, we're seeing incredible response rates. I mean, with CAR T therapy, you're seeing complete response of an otherwise fatal leukemia to the tune of 80 to 90%. And of course, we're going to have to assess the long-term durability of that, but that is truly incredible.
Right.
So I think as well with the innovation, you have to have a well-functioned regulatory environment. You're seeing the FDA work very collaboratively with companies, looking, even doing, for example, single-arm, 80-patient trials for approval in a very targeted population where you're seeing tremendous response rates. And as well, you're seeing regulatory approval. So for example, Blincyto at Amgen was approved in under 3 months after submission to the FDA. That's incredible. So that's why I'm not in cardiovascular. I don't want to do 15,000 patient trials that take 10 plus years. Oncology is really the best place to be.
So we
from
won't
that
see a
perspective.
diabetes fund anytime soon.
No, I mean, that's been, obesity,
Sorry, but
cardiovascular,
for stem
those are
cells.
tremendously painful fields, regulatory
Well,
perspective.
just before you get to this, I mean, one of the people I would credit for a lot of what's going on at the FDA is Richard Pastor. Several years ago, he came out and said, look, we've got this accelerated development program that's going on right now, breakthrough therapy designations. We mean it. I'm going to back it up. We're going to make it happen. And that's exactly what happened. And that doesn't always happen in a bureaucracy. David?
Yeah, no, I agree. I mean, I think that really changed the game and
Right.
gave people a very clear path towards, having a
Right.
collaborative regulatory environment. I did think it was interesting that the priority review vouchers became a little bit like taxi medallions in terms of the tradability of that, and that's been a fascinating market.
That's one pricey taxi you got there.
That is a pricey taxi, yeah. But that's something as lenders we're like, God, could we underwrite around that? Those seem to be really valuable, but we haven't quite gotten there. One thing I was just going to mention is, in the patient experience around the current version of CAR T the patient experience with so many cancer treatments is horrific, right? It's a really tough treatment paradigm. It's a tough disease. Coming full circle back to where do the stem cells fit into all of this, there are some interesting pluripotent stem cell innovations around CAR T that could maybe make that a more scalable, sustainable, effective treatment. I don't know if we can pontificate that that's actually going to happen, but there's some big ideas around that.
One of the things to also bring up on the regulatory environment is something that I haven't seen. I know, John, you've been doing this much longer than I have, but I've never seen a clinical hold being lifted in a number of days, especially when it's 3 patient deaths being involved. I think that's very telling. That's Rick Padgester's influence, saying this is something we believe in, we understand what happened, to the extent that they do. But usually, you have a manufacturing issue and the trial's on hold for 3 months. And here you had something that's lifted in a matter of days. I think that's very, very, very telling. It tells you that FDA is willing to work very closely with companies and be very flexible, much more different than 5 years ago.
Take some chances.
And as I say, this is transforming the investment model. If you think about it before, you really did need 10 years and $1 billion to get to the finish line. Now look, if you look at a targeted therapy in oncology, you could literally get approval with 130, 150 patients of data, single-arm trial with a targeted patient population and companion diagnostic. That completely changes the investment model, and from my perspective, makes it much more attractive.
Great. Well, again, I appreciate everybody turning out today, and I'd like to have a big round of applause for our panelists. It's been a great discussion.